The Little Book That Makes You Rich by Louis Navellier. Welcome to yourbooksummary.com. Alpha and beta are two important concepts in finance that help investors understand the risk and potential return of a stock. Beta, this measures how much a stock moves in relation to the overall market. A beta of 1 means the stock moves in line with the market. A beta higher than 1 means the stock moves more than the market, while a beta lower than 1 means it moves less. A negative beta means the stock moves in the opposite direction of the market. Alpha, this measures how well a stock performs compared to a benchmark index. A high alpha can be due to strong demand for the stock or short selling of weak stocks. Alpha shows what makes a company special. It's important to calculate alpha and beta correctly to understand a stock's risk and potential return. By analyzing fundamental factors in alpha, investors can assign a letter grade to a stock to determine its reward and risk. Stocks can be conservative or risky depending on their performance over time. To build a diversified portfolio, investors can mix conservative, moderately aggressive, and aggressive investments. This helps to balance high returns with low volatility. Investing in stocks with different alpha and beta values can help offset market risk and protect your portfolio. I hope you found the information about The Little Book That Makes You Rich by Louis Navellier. This brings us to the end of this book. Check out our YouTube channel if you're hungry for more knowledge and want to explore other books. It's chock full of informative videos and recommendations to keep you engaged and learning. So head on over and subscribe today. Thanks again for watching, and I will see you in the next video.